Sanjeev Prasad is our man of the moment. He's Managing Director and Co-Head at Kotak Institutional Equities. He's joining us now to take some questions. Sanjeev, good to have you with us here. Thank you very much. I think, you guys today brought down Cochin Shipyard and targets there a notch. Talk to us about what's happening here in this space, in the shipbuilder space, with some data and some numbers, and what one should do here if one doesn't already have exposure. Go on.
That's not the shipbuilder space. Like anything to do with defense and the broader capital goods space has been on fire for the last 6 months now. Yes, there is a powerful investment theme which is building up, but now clearly the narrative is well ahead of the fundamentals. And some of the stock prices are very, very hard to now rationalize. We had a positive view on Cochin Shipyard, but the weight has gone up in the last 2 days. 20% up yesterday and another 7-8% up today. Clearly, how do you rationalize these things here? There is some expectation of second aircraft carrier order being given to Cochin Shipyard, but looks like the market has assumed not only will the second one be given, but a third and a fourth, and God knows, what else. So everything is getting discounted so early, without any signs of any orders being given or any execution risk being factored in. It's very hard to even try and rationalize these things anymore.
And that's why the joke's coming. Anyway, Sanjeev, is the broader market also giving you is it generally very expensive on a variety of matrices, or you think not really? What's your sense? Because there is a fair bit of debate on that one. We actually had a couple of fund managers with us day before yesterday. We had Tahir Badshah and Pankaj Tibrewal, and Tahir was saying, well, he wouldn't focus on indices themselves, but the economic cycle. So that kind of justifies what's going on. And Pankaj was on the other side. Just curious to know where you stand on this one.
Well, it depends on which part of the market you're looking at, to be honest with you. So if you look at the large cap indices, like the basic 30 and nifty 50, I think can still make some case over there. Valuations are high, but they're not, crazy. Look at Nifty 50 on a 1 year forward index, it's 1 year forward multiple, it's about 19.9, which is not too bad in historical context. Look at the 5-7 years, it's still not looking that crazy. Of course, some of the individual names are on the higher side, and there are risks to business models that are emerging, which should result in derating over a period of time. But it's not as if you're in a bubble zone or anything over here. But if you look at the mid cap and the small cap indices, particularly as you go down the quality curve, the less known mid caps and lower quality small caps, and that is where the real froth is, and that is where the excitement of the market is, I guess, at this point in time. You can see from the number of folios being opened in the mid cap and small cap funds, you can see the money which is going into all the mid cap and small cap funds entirely. Look at the low data for mutual funds in the last 4 months. If we collect currently, somewhere about 250 billion rupees has been put into equity mutual funds. And all the money has gone into mid-cap and small-cap funds. In fact, more than that, there is actually a money coming out of the large cap and the flexi-cap funds. So that is the mood of the market. Given the performance of mid-cap and small caps, there is now more money chasing the stocks. And given the liquidity of the stocks is not that high, obviously, many intend to buy results and prices going up, and that results in more money coming and now becoming a crazy upcycle. Obviously there is a big disconnect between fundamentals and valuations in many of these names. I don't know what will break the cycle, but clearly there is a lot of discomfort with respect to valuations of many of the mid cap and small caps. I think the large cap names are probably a lot more I would say at least somewhat sensibly valued, compared to the madness we are seeing in the mid-cap and small-cap names now.
Sure. By the way, the market is picking up pace. Just look at that, going like a rocket as we speak. I mean, the Nifty is now almost at 19,800. And big moves coming into individual names. It's not just the Mazgaon docs of the world that's, gaining all the limelight. Look at transformers and rectifiers, 15% higher on that stock now. So big mover in the mid-cap space. You have a lot of these names like NMDC, NTPC, GAIL, Petronet LNG that are all at fresh 52-week highs. So lots happening in the PSU arena as well. And then, names like DLF, Varroc Engineering, HCL Tech is at a fresh 52-week high. So that this market is sort of ablaze with a lot of ideas. Sanjeev, good morning and thanks for being with us. Where do you see the next pocket of growth come through? There's so much, right? As we were saying, anything and everything is rallying now. But where do your preferences lie?
From market perspective, you're saying?
Yes, from like sectoral angle.
Well, I hope you don't lose too much capital by the end of, let's say a year or so, because clearly we are in crazy zone as far as many of the mid caps and small caps are concerned. So I would try and preserve my capital to the best extent I can by being in the large cap names if I have to be necessarily invested in the market. And within the large caps, the places where you can at least make some case for valuation being reasonable are really the banking and financial services names, including insurance. Some of the healthcare pharma names are still looking reasonably okay, I would say. And beyond that, pockets of consumption names are okay, at least for the time being. But honestly, that's about it. Anything to do with capital goods is looking extremely expensive, whether it's large cap or mid cap. Anything which is to do with, let's say, real estate has now gone to somewhat uncomfortable levels. I would say again, you're fairly positive on housing cycle. You're clearly seeing a big, housing cycle which has been in play in the last couple of years, and that should continue for the next several years. But the problem is in India, everything gets discounted so early. Next 5 years, earnings get pulled up. So in that case, you could have a situation where stock prices don't benefit for the next year or so. I don't see a big correction also. Looking at the medium-term prospects of India seem to be very, very good. Given the status of other emerging markets, most emerging market investors would look at India more favorably even in the correction. So I don't see a big correction, at least in the large cap names. So that's my preferred segment for the time being.
Hi, Sanjeev. Good morning. You're clearly sounding a little bit more cautious then. In the last time we chatted, I quizzed you about what are you making of this promoter selling? You said, well, that's a hint, right? If promoters are selling. But it seems post, the last month and a half since the time we last spoke, promoters have sold even more. And all of that is getting lapped up. What's your comment on it? Are investors getting a good entry, or are promoters taking money off the table at the right time?
Well, there are investors clearly who don't want to take the hint, If promoters are selling and they are the biggest insiders, they know what is the fair value of the companies better than any of us will ever know, right? So if the PE guys, the promoters themselves are selling, that gives you a fairly good hint as to what is going on with respect to valuation in the market.
I guess, the way forward is that there are a lot of these sectors which were laggards that are coming back after a long while, right? I mean, you were talking about capital goods, there's infrastructure, there is defense. Defense has not done anything for last 10 years, and now suddenly in the last 2 years, it's come back in a big way. Sugar is coming back as well. So if you are a bit cautious at these levels on the mid-cap space, where do you still see some valuation headroom? Both in mid caps as well as in large caps? Do you still like IT and pharma? Because IT has come back as well.
Not really, Sonia. If you look at the bottom of valuations across the board, there isn't much value left in the market, barring, as I was saying earlier, the banking and financial services space, pockets of pharma, healthcare, and consumption. But that's about it. Either stocks are fairly valued, which is probably the case for the IT services companies, or they are expensively valued currently. And then you have many of the mid-cap and small-cap stocks, so we don't even get me started on those. No point in talking about things we really can't comprehend anymore. Like going to a movie, trying to understand the movie when it's a different language, compared to your natural language. Can't understand anything. So after some time, you just stop, applying your mind and start enjoying the movie. Whatever is going on, you enjoy the fun.
Across your coverage universe, Sanjeev, how many buys do you have now?
I will have to look at it, but 1 second, hold on if you want to.
I mean, just to get a broad sense, I mean, is it 25% of the names? Is it...
more buys than sells?
Hold on 1 minute. We have about 28% of our universe is still a buy.
Okay.
And about 58% is that. So we have about 45% of our universe has reduced or sell now, which is roughly half the coverage.
Okay. Just one more question on a specific space. This is the EMS space, Dixon and Amber and Keynes and Sirma, etc. again, what's the call here? Markets are, it's an opportunity, absolutely, no doubt about it. Electronics are the second biggest import for India, and we start to make a lot of it here. So the road is a long one. But the question is whether one can buy these now at where they're trading. Go on.
Oh, if you do a reverse valuation of these companies and the initial coverage on Dixon, yes, there is a long runway of growth, but if you just do a reverse valuation, the kind of numbers which have been thrown up in the outer years is like staggering. In case of Dixon, for example, the company should have, something like 50 to 70% market share in many of its current lines of businesses. That is obviously not going to happen, unless and until we are completely underestimating the growth. But we have been very generous in our growth assumptions. We are very generous in our profit assumptions. Even then, the market share being implied by the current stock price, 10, 20 years down the line is so high, it just doesn't make any sense, to be honest with you. But yeah, the next 3 years, 5 years growth will be fairly strong. So I guess that's what the market is focused on as of now. And forget 3 years, I guess the market is more focused on the next 3 months for now.
Absolutely. Fair point, Sanjeev. Actually, we, in a little bit from now, we have the management of Dixon joining us. If you're interested, you can listen in. But thank you so much for joining us and running us through your perspective. Always interesting to speak with you, Sanjeev. Well.